Hi, my name is Michael Tyler. I'm the Chief Investment Officer at Eastern Bank Wealth Management, and I'm here to talk with you today about opportunity and risk in the investment climate today, what we see happening in the economy, what we see happening in the markets, and how we think you might want to think about your investing. Just to give you a quick background, I've been the Chief Investment Officer at Eastern for about 2 years. Before that, I was a partner at Wellington Management, having an equity analyst and portfolio manager role, and I advised clients as an investment boutique CEO in California for a few years. I also managed a hedge fund at that time. But let me start today by talking about a philosophy of investing, what we think are the most important principles to follow, and how we think about asset allocation, because that's a key element of how to invest. And I start with this basic premise. Money is a tool. It is not an animate object. It has no soul. The only reason that money exists is so that you can do something with it. So the real question is, what do you want to accomplish with your money? I've listed in this chart a few things that some people are interested in. Obviously, you may have others. You may value some of these more than others. Each person's chart, if you will, of what their objectives are is unique to that person. But once you set your objectives, once you know what you want to do with your money, then you can think about investing, because each of these objectives has its own implications about how to invest and how you want to put the money to work. We start not by chasing returns, not by trying to figure out what the next hot stock will be, but instead to understand that the real key to investing is managing risk. Risk works both ways. It's a risk that things don't work out, but it's also a risk that they do. And so you don't want to avoid risk and just put money under the mattress. You also don't want to embrace risk all the time, because you could be hit by an oncoming train. Instead, you want to manage risk. You want to think about different sources of risk, as I've shown here, and you want to think about which of those might be properly valued in the market today, which of them might give you more opportunity, and which of them might scare you at any given point in time. And you can quantify all of those. When you think about risk in this way, you also realize that your return can come in many different ways. Sure, growth is one of them. That means that the price goes up. But you're also getting dividend or interest income. You're also thinking about tax efficiency and liquidity, that is to say how quickly you can get your hands on your money if you need it, and about controlling for different kinds of risks that may happen. The most important decision that we're going to talk about is strategic asset allocation. And what I mean by that is the decision to, over the long period of time, whether you want to be more in stocks or more in bonds, or how to balance those two. What's your so-called neutral allocation that over a long period of time represents where you think you want to balance your assets? And there are reasons that you would want to own more stocks or more bonds or more of other assets depending on your own personal needs. You would then rebalance periodically to get back to that point. But in the meantime, you'll have a tactical asset allocation, which is more short-term, and this really refers to recognizing current economic and market factors that would dictate whether you want to be underweight or overweight compared to what your sort of normal neutral allocation is. So let's talk about that neutral or strategic asset allocation. This chart shows you different mixes of stocks and bonds. You could do it for any asset classes, but let's work with stocks and bonds. On the vertical axis is the amount of return that you can get, and running across the horizontal is how much risk you would take. Now, typically equities or stocks have more risk in them. That is to say, their prices fluctuate more often. The price is more volatile in a stock than in a bond. They both have risks, but they have different kinds of risk. And so if you want the least volatile portfolio, the least risky in that sense, then you'll be in all bonds. That's at the far left of the chart here, where it says maximum income. At the current interest rate, it may not be that much income, but it's the least volatile. You'll notice that as you add some risk in the form of adding some equities, your potential return goes up fairly meaningfully. But that isn't a linear relationship, so that by the time you get out to the far right of the chart, if you go from 75% equity to 100% equity, you're taking a fair amount more risk, but you're not getting a whole lot more return associated with it. So be thoughtful about where you want to be on this risk versus return spectrum. There's no right answer for everybody. Each person has to find their own balance. Let's keep that in mind as we talk about what's happening in the markets today, where we want to be tactically